Three documents decide whether anyone, an investor, an endorsing body, a bank, trusts your numbers: the profit and loss statement, the balance sheet, and the cash flow statement. Most founders can describe the first. Fewer can read the second. Almost none build the third until things go wrong. In the next 5 minutes, we'll walk through all three, see how they connect, and cover the principles that make them credible, so you're ready when an assessor asks.
The profit and loss statement answers one question: did this business make money during this period? Let's trace the lines. Revenue is the total value of sales recognized when earned. Subtract cost of sales, the direct costs of delivery, and you get gross profit. Using our illustrative example, £180,000 revenue minus £60,000 cost of sales gives £120,000 gross profit at a 67% margin. Deduct operating expenses, salaries, rent, marketing, totaling £83,000, and operating profit is £37,000. After interest and a £7,000 tax charge, net profit lands at £28,000. That bottom line is what feeds the balance sheet.
The balance sheet is a snapshot, not a video, of financial position at a single point in time. One equation governs everything. Assets minus liabilities equals shareholders' equity. It always balances, without exception. Assets split into current, cash, unpaid invoices, and non-current, such as equipment. Liabilities split the same way, due within 12 months and longer term. The difference is equity, what belongs to the owners. For a Visa assessor, a positive and growing equity across the 3-year projection confirms the business remains solvent. For an investor, it shows a company that is building value.
Here is the truth that trips up founders. Profit is not cash. Your P&L can show £28,000 net profit while the bank account sits near zero. Why? Timing. You book revenue the moment you raise an invoice, but a customer paying on 60-day terms means cash arrives 2 months later. Meanwhile, you've already paid staff and suppliers. The cash flow statement resolves that gap. It tracks every real movement of money in 3 buckets: operating, running the core business; investing, spending on long-term assets; financing, money from investors and lenders. The net total equals the change in your bank balance.
To see how all 3 connect, trace one sale. You invoice a client £10,000 in December. On the P&L, that's revenue in December. Earned, so recognized. On the balance sheet at 31 December, it's a trade debtor, a right to cash that hasn't arrived yet. On the cash flow statement, the operating section flags it as a working capital adjustment. Cash collected is £10,000 less than revenue. 3 statements, 1 event, 3 vantage points. And the cross-check every assessor applies: closing cash on the cash flow must equal cash on the balance sheet. Net profit must flow into retained earnings. The rules behind every number in your financials are called Generally Accepted Accounting Principles, GAAP, expressed in the UK through FRS 102. Accruals. Revenue is recognized when earned, not when cash arrives. Matching. Expenses belong in the period that generated the related revenue. Prudence. Book probable losses immediately, but only recognize gains when realized. Going concern. Directors must confirm the business can operate for the next 12 months and disclose if they have doubts. Consistency. The same policies year after year. For a visa application, these principles are what make your projections legible to an assessor.
All 3 statements, P&L, balance sheet, cash flow, can be generated in minutes with cloud accounting software like Xero. The bank feed pulls transactions daily. The platform applies double-entry rules automatically. The practical result: when an investor asks for management accounts, you can deliver them before the call ends. For a Visa application, actual accounts from a cloud platform carry more weight than projections alone. They show financial discipline in practice, not just on paper. Set it up on the day you incorporate. Backfilling historical entries later is expensive and error-prone.
The P&L covers a period and shows performance, revenue down to net profit, gross margin as the first health check. The balance sheet is a snapshot. Assets minus liabilities equals equity. The cash flow statement tracks real money in 3 sections, separating profit on paper from cash in the bank. All 3 interlink. Net profit flows into retained earnings. Closing cash ties to the balance sheet. GAAP principles determine how every number is recorded, and cloud accounting keeps all of it current, consistent, and ready when anyone asks.
The full Financial Fluency series, every article,
Worked example and template is at torlyAI. Run a free assessment while you're there. 5 assessments, no card required. The P&L, balance sheet, cash flow, and how they interlink are each covered in detail in the linked articles below. And a reminder, this has been educational, not financial advice. Verify current rates at gov.uk and consult a qualified accountant for your specific situation.